I am just not getting GameStop. Can you help me make sense of this? It's a brick and mortar store. There's a pandemic out there. People are just like waiting in line for video games. Are you listening? Why would people even go and do this? It's the 21st century. What's this Keith Gill guy smoking? I get that they just added Ryan Cohen to the board, but dude, why am I even on this stock?
Then you went to HBS. That's exactly why we're interested. You do realize the stock isn't worth more than 20, right? And it's at $40 right now. 40. That's what shorting is. We are going to ride Keith Gill's propaganda and we're going to exit once the market stabilizes. We are going to do that because these guys don't know what a shitty stock looks like.
Yo, dude, have you seen this? Check this out. I think the hedge funds and investors are definitely shorting GameStop. Should we cause some trouble?
You know what? I'm so tired of getting screwed by these hedge funds a-holes. I don't even care if we don't make any money. Let's just buy and hold and spread the word.
Yeah, you know what? It's our time. Let's show them some real loss porn.
I like the idea of loss porn.
Let's do it. Oh my god, girl. Did you see this? GameStop? You know what that is, right? You know, like where you go buy video games in a store?
Yeah.
I have a friend who's been buying all this stock because it keeps going up and up, and she made $40,000. She's paying off all of her student loans. I think we need to get in on this and take it to the moon.
Oh my god, are you kidding me? We gotta get on that spaceship. I've been saving for a new car, but if I could double that money, I could get something I really couldn't afford otherwise.
Yeah, let's do it.
Oh my god, it's insane.
As Wall Street Bets investors bought more and more GME stocks, the price of the stock soared, peaking at almost $350. As the stock continued to rise, the shorts continued to lose money, forcing the hedge funds to buy their shares back at a higher price than they had purchased it initially.
We predicted this. This is ridiculous. We need to get out now. I don't understand. What else is there to do?
Boss, you should see this. It just keeps going up. It was just $40 and now it's close to $100. You told me to buy when the prices go down, but it's going to the moon. Do we hold? Do we stay? There's just no way GameStop is worth this. These assholes are screwing us.
Just pull out. This is too much. Just pull out. Just pull out. Dude, have you seen? What the fuck? Robinhood's restricted on trading on GameStop. This is so totally unfair.
Ugh, I know, I saw. The big hedge funds always seem to cheat the system, and nothing ever happens to them. I mean, now that we're getting some type of traction, these platforms are restricting us. The little guy will just never win.
We thought we were leading the charge, but somehow we still got the short end of it. It's ridiculous.
What's up? Why are you calling me?
Have you seen it?
No, what happened?
The numbers. I don't understand what's going on.
What are you talking about? Show me.
It just keeps dropping. I put in more. Than I planned. I put my kids' college funds in.
Oh my god.
We need to exit.
We need to get out. I'm gonna go to my computer. We gotta get out.
Let's go.
The premise of GameStop in 3 sentences is that 1. Short sellers took notice of a stock that was supremely overvalued but ended up losing money because investors stubbornly held on to their stocks intentionally to force short sellers to lose money. 2. It started as a David versus Goliath story where the retail investor is David and Goliath are the hedge funds. Finally, 3. The many heads of David had a simple plan. Hold stocks and not sell even though their stock increased in value, forcing short sellers to close out at prices that were higher than they had intended. How? From Roaring Kitty to Wall Street Bets, the intention was clear. It was to stir up a frenzy and weaponize investor sentiments against the evil hedge. Wall Street Bets acted as a confirmation bias as comments that were most liked were bumped up, and so it acted as an echo chamber leading to gambler's fallacy. That is, thinking that their time had come. Now let's move on to short selling. What is short selling? Short selling is basically levered investing that involves betting stock prices will fall. Usually, short sellers are institutional investors like hedge funds who play a role in assessing a company's fair value and actually restrict the investor's excessive enthusiasm. In doing so, enables self-interest driven arbitration of mispricing. In simple English, mispricing occurs when prices differ from the fundamental value and hedge funds arbitrate because there is money to be made. However, there are limits to arbitrage, and this was illustrated by the collective movement of the real retail investors of Gamestop who determinantly held on to their stocks on purpose. When a stock irrationally trends upwards, more people jump on it and so drive the prices up higher. It becomes a vicious cycle of increased demand and price due to the fear of missing out of investors who are jumping on the bandwagon, who are late and have delayed information. These increased high prices squeeze the short sellers out of their positions, forcing them to close out and repurchase the stocks at higher prices instead of lower as expected, which again pushes the price even higher as demand soars. So what did we take away from this? Gamestop epitomizes the Shiller model, where we see that fundamental value is exaggerated by investor sentiment, causing prices to be driven up higher than anyone could have imagined. Hence, price clearly is not equal to the value, especially if there is human involvement, as with human involvement, there is irrationality. In this situation, the efficient market theory is rendered void because the market is obviously not operating fairly. Gamestop can be seen as an example of where this theory is not true, as the price soared more than 700% from $3 to $350. It was unclear what the fair market value of the stock is, as it adapts to the constant flux of investor sentiments, leading to costly mistakes by retail investors. How were retail investors so easily ensnared and whipped into a frenzy? That's where the trading platforms come in. The zero-commission trading applications like Robinhood and Charles Schwab allowed the Wall Street Bets movement to gain more momentum, as these trades were so easy to access by the dumb money retail investors, unlike funds that charge for ETFs, which leads to investor psychology of overconfidence. Robinhood entered the scene under the guises of democratizing finance for the retail investor. However, nothing comes for free. They direct customers' order to market makers like Citadel Securities, who pay Robinhood for the orders. Citadel Securities make money by using high-speed trading algorithms to exploit the differences in the buy and sell price that are minute in value but compound over the millions of transactions. This is standard practice for brokers, but Robinhood, or less affectionately known as Robbing Hood, basically aimed to steer the retail investors astray and make bad decisions, and sold those bad decisions to high-trading market makers for their own gain. The gamification of the experience exploited trading to help push investors into making bad decisions. Yet, when the volatility kept increasing, they curbed stock buying and were slow to explain their decisions, and so were suspected to be siding with the institutional investors.
GameStop is neither party deserves a criticism here. On one hand, we have the hedge funds who are basically, providing capital to a lot of startups, private equity investment funds, and which is very, very crucial for our economic growth. So I don't think they deserve any criticism for short selling a stock. This is something that they have been doing for years and years. And then on the other hand, we have retail investors like you and me. Where we have every right, because it's a public market, so we can have our own opinion, and we can feel that a stock is, we can be bullish on a stock, we could be bearish on a stock, completely our choice. The hedge fund industry is no doubt a little way less regulated than any other industry, but that doesn't mean that they are doing some sort of a gambling. There is a lot of hard work that goes into that industry. There's a lot of effort and a lot of investment in the hedge funds as well. So it's time that you educate normal investors, like what is their role. As an investor, you should know your role as well. It's not like, of course, nobody's stopping you to go buy a stock or short a stock, but imagine that your action, or when you are basically manipulating a group of investors' decisions, can have chain effects, right? So therefore, whatever you do can have a big impact on the market. There was nothing great about that company GameStop. Why would you be bullish on that? What is the rationale behind it? And the rationale can't be that, okay, this was just like some sort of a momentum. I wanted to just feel the thrill. It's because when people forget about the hedge funds who lost billions and a lot of money, but they were still hedge funds who came in, who stepped in to help them. But when retail investors see you and me making billions and billions, and there are some other investors who are entering and buying the stock at such a high price, and eventually, because this is all a momentum game, the stock is going to just fall down, and that's what happened. So eventually what you did, of course, impacted the hedge fund industry, but it also impacted people like you and me. So it did not make sense, right? I mean, because fundamentally the stock did not have anything strong. Was when there's cheap credit all over the place, and especially during pandemic, and there are apps like Robinhood who is basically charging you, zero commission on your trades, people will go ahead and bet more than their capacity. We kind of go more and more digital. These are the challenges. These are the areas that should be concerning to us, people who are there in the financial markets, so that we make an educated decision as collectively in the industry.
So to me, it was a small group of individuals basically rallying this untapped kind of dispersed retail investment group, and in a Reddit community, and really lobbied and pulled people together to gain some momentum and implement effectively a short squeeze, right? They effectively pooled capital together and almost like market manipulation, just floated the GameStop shares very high. And so to me, really, from like a more macro level, what happened was kind of a failure of one of the key principles of the wisdom of crowds. That's what it is. So with the wisdom of crowds, one of the most important fundamental drivers of efficient markets is independence of the individuals participating, right? And so, with GameStop, these retail investors basically banded together and thought, banded together, pooled capital, like-minded capital together, and had a kind of a herd mentality, basically pumping the stock price up. And it was also kind of an FU to the hedge fund guys in New York. So it was a really interesting case. But anyway, so the independence criteria for the wisdoms of crowd kind of methodology or whatever, it was broken down, and everybody had this like-minded mentality, and so the stock price pumped. From a valuation perspective, right? Like, this is just too much of a speculative play to me, right? And it's capital basically chasing a short-term strategy and speculative market flex or play, trying to get these big hedge funds guys to lose their shirt for a company that doesn't really have any concrete business value driving the valuation, right? So I think it's interesting that it happened, but it's not something that I would personally want to partake in. But I'm an old school kind of value investor mentality. So, the people who are more risk tolerant and are comfortable making speculative plays, you know, a lot of people made money on this short squeeze in GameStop situation. But would I participate? Probably not.
When it comes to investing, one cannot be tempted by sentiments alone, even though it may seem like a lucrative trade. We need to stick with the fundamentals and understand how psychology of investors can at most times not represent the true value of the market. If you're thinking of investing, always get into it with as much information as you can, and be wary if the market is trending ridiculously upwards with no real explanation. If something is too good to be true, then it probably is.